Hi everybody, welcome to my webinar on price patterns. This is one of the oldest forms of technical analysis, which is known as classical technical analysis. Nothing really weird and wonderful and rocket science about these methods. These are old, tried and tested methods. So I'm going to give you some of these patterns which have predictive value for various markets. Now, price patterns are based on market psychology. They reflect basically a battle between buyers and sellers. So when the market starts to trend, you'll get the market moving, for example, in an uptrend. It will swing higher, and then you'll see a correction to the downside, which involves usually one of these price patterns, which denotes the kind of a temporary pause in the trend prior to seeing some resumption of the trend most of the time. Oftentimes, because trends do reverse, you'll get a reversal pattern. So price patterns break down into reversal and continuation patterns. So as I say, the price pattern reflects two-way trading, a battle between the buyers and the sellers. So when there's a trend move, it seems pretty obvious who is winning the battle. But eventually a move will run out of steam, people take profits, some people go counter trend, and you get this kind of two-way choppy action, which most of the time, because trends tend to persist rather than reverse, they tend to be continuation patterns. I'll be talking about a range of these patterns which have been used for many years, decades, by technicians and traders to give them a kind of an idea about directional bias for a particular market. So they're typically a period of market reflection after a directional or a trending move. So as I mentioned, price patterns, they reflect mass psychology, and that is the main driver of demand and supply. A lot of people talk about there are fundamental drivers for a market, but at the end of the day, the market is driven by mass psychology, greed and fear, and this comes out in the price patterns that you see on the charts. So technical theory holds that price patterns are to a large degree predictable, have some predictive value, and because they reoccur, that makes them, you've got a lot of occurrences of the same kind of pattern, so that gives you a bit of statistical significance, which gives you a good degree of confidence that the pattern could work again in the future, should work again in the future. So a trader, what their job is not so much to predict the market's direction per se, it's really to figure out the path of least resistance. Which way is the market likely to go? And to back the winning side at the end of the day. There's no kind of bias should not really come into it. A bias should be determined by the facts on the ground. So when a pattern has been completed, usually confirmed by a closing break outside of a trend line, which defines the pattern. That gives you the signal that the pattern has been completed, a directional bias, and you've got a minimum target on which to expect the market to move. So the first one we'll talk about is probably one of the most famous ones that technicians like to talk about. And that's called the head and shoulders reversal pattern. Initially, I'll talk about the head and shoulders top pattern. So the way it works is the market is in an uptrend, and then making a series of higher highs and higher lows. And then the market pulls back from what becomes the left shoulder of the pattern, pulls back, makes a higher low, breaks higher, breaks through the top of the swing high, extends higher as one would normally expect in an uptrend, but crucially, when the market pulls back, typically what happens is resistance becomes support once it's been broken. And there's a reason for that, because basically people who sell on the approach to a resistance line, if the market breaks through it, they realize that they're wrong. And then when the market comes back, they want to get out literally as close to their entry price as possible. So support and resistance flip over when they're broken. So what happens in a head and shoulder pattern is the market initially makes a swing higher within an uptrend, which is quite normal and to be expected. A pullback happens, again, normal to be expected. And then the market breaks through the swing high, again, expected within an uptrend. And then when the market pulls back this time, what it doesn't do, it doesn't base at or close to the old resistance level, which is the left shoulder here. It goes all the way down to around where the so-called neckline of the pattern. In other words, it comes back down towards the last high or low within the uptrend. Then you get a bounce, and what happens with a classic head and shoulder pattern is this bounce tops out pretty close to where this left shoulder is. So the market tops out, it doesn't break up towards the head of the pattern and make a new high. In an uptrend, it would normally do that. But instead, tops out, starts to break down, and the pattern is completed when you get a closing break of this neckline. So you have the left shoulder, the head, the right shoulder, and this is the neckline of the pattern. So once it's complete, you get a target, a minimum target for this this reversal pattern is the distance from the head, in other words, the highest point of the pattern, down to the neckline, projected from the neckline. Okay, so that gives you a minimum price objective for this pattern. Now we just had one recently, and I'll go over it later on with some of the examples when I look at some of the markets. We just had a really good one break on euro yen, and there is a potential head and shoulders top on euro dollar, but today it's struggling around this neckline. So it's broken through it, but doesn't want to close below it, at least not yet. Anyway, we'll come to that a bit later on. Okay, so just to show you a few examples of this this pattern in action. This is a chart of dollar yen, a weekly chart of dollar yen. And what we had here was the market swinging higher, correcting lower, swinging higher, correcting lower, nice uptrend, bullish action. And then the market goes into a bit of consolidation, breaks up, makes a new high. And then when it pulls back, this time initially supported at the top of the left shoulder, where old resistance becomes support, but eventually it breaks through. Now, that's the first sign of weakness within an uptrend. So this first swing down here gets supported pretty close to the last higher low within the uptrend. And then the market bases out, tries to go higher, does not take out the head or the top of the pattern, tops out a little bit up above the left shoulder here, as I mentioned, starts to break lower, a bit more support from the neckline, and then breaks through, and then that's the reversal pattern. That's the confirmed reversal in trend as forecasted by the bearish head and shoulders top pattern on dollar yen in this example. And then you get the minimum objective, which is the head down to the neckline, subtracted from the neckline where it broke. So that gives you a target somewhere down there, which it hit fairly quickly. Okay, so that's the first example. Another example here, this is sterling dollar cable, a weekly chart again. And the market is in a nice healthy uptrend, making higher highs and higher lows like this, higher highs, higher lows, higher highs and higher lows. And then eventually the market tops out above 210, 211, tops out and breaks all the way back down towards this support level here. So we got ourselves a left shoulder, quite a large head. Then the market rallies, tops out, forms the right shoulder of the pattern, comes back down, a bit of support at the neckline, slightly sloping in this case, eventually breaks down, and that's the confirmation of the head and shoulders reversal pattern for cable. And the market obviously accelerated lower in the subsequent weeks and months. Another example here, this is Australian dollar, Aussie dollar, Aussie US. The market, this is a 4-hour chart. This thing works on just about any time frame. So the market is trending higher, higher highs, higher lows, higher highs, higher lows, and eventually tops out and comes back through the old support level here, initially supported at it because buyers come in, but then it breaks down. And again, the real support comes in here at the last higher low. Market starts to rally. People think it's going to make new highs again. But what it does is it tops out pretty close to this left shoulder peak. So what you should be doing when you see the market break through a swing high in an uptrend and then come back and then settle back below it, or move below it aggressively, is draw a horizontal line from the from the left shoulder. And that'll give you an idea as to where the market could possibly struggle if the market is going to be forming a head and shoulder top pattern. So what happens here is the market bases out, tries to break higher, couldn't break above this left shoulder. So basically what this means is the guys or the ladies who bought the break of this swing high are trapped. So anyone who is still holding long, having bought the break of this high in the uptrend, looking for new highs, they're now trapped. So should the market bounce, they try to get out at any price they can to avoid the loss, and that creates supply above the market at that price level. So of course, eventually it breaks down, a little bit of choppy action around the neckline, but sure enough, it breaks down quite aggressively, and that confirms the reversal in trend to the downside. Okay, that was head and shoulders top. So basically in chart analysis, what works on the way up also works on the way down. So this is the inverted or inverse head and shoulders base pattern. So essentially it's the mirror image of the head and shoulder top pattern that we looked at just now. So what we have is a downtrend, the market is trending lower, finds support as short sellers cover. We get a bit of a bounce as one normally expects in a downtrend. Then the market breaks down, makes a swing low, a new swing low, as one normally expects in a downtrend. But what happens again is the market bounces, but instead of topping out around the old support level, as one would expect, the market breaks up and quite aggressively, and then eventually tops out close to the last lower high within the downtrend. Then the market starts to pull back. People think that the downtrend is resuming, but again, those who sold the break of this left shoulder here are now trapped underneath it. So the market comes down and is supported on the approach to this left shoulder. And then new buyers come in along with those that are bailing out of losing short positions. The market breaks up and eventually breaks through the neckline, and that gives you a bullish reversal in trend. And again, as all of these patterns have price projections, minimum price projections, based upon the width of the widest part of the pattern. The projection is basically the neckline minus the head, in other words, the lowest point of the pattern, projected up from the break point. So that gives you a minimum price objective for the inverted head and shoulders base pattern. Okay, a lot more common are double tops for sure, triple tops not quite so common. And they are basically where the market has 2 or 3 attempts in the direction of the trend, but eventually the market then can't do it, breaks down through the what's known as the baseline. In other words, the trend line drawn below the reaction lows or the reaction highs in a downtrend, and that confirms the reversal in trend. So 2 or 3 pushes to a new price high in an uptrend like this, attempting to push higher. But then the market breaks down, it runs out of steam, and eventually breaks through this trend line, this close enough horizontal trend line that connects these last 2 these 2 troughs within an uptrend. And once you get the closing break through them, then again, as with the head and shoulders pattern, you're looking for the widest point of the consolidation or the pattern minus the baseline, and then you project that down from the break point to give you a minimum target. So let's say for supposition, the price is trading between 100 and 200. The market, the width of the pattern is 100 points. So you subtract that from 100 and that gives you the target to the downside. Probably not a good example, 100 and 200. Think 1,000 and 900, and that gives you a 100 point projection to the downside rather. Same thing on the triple bottom or the double bottom. Market is trending down, bounces back up, comes back down, has a go at the lows, maybe takes it out marginally, maybe bases slightly above it, comes back up again, finds resistance at the old high, breaks down again, bases out, can't make a significant break below, and eventually comes back through this trend line known as the baseline, and then you've got your minimum projection to the upside based on the widest point of this pattern. So a few examples here. First one, this is the euro against the pound, euro sterling on a daily chart. So this one is initially trending lower, swing high, correction, swing low, correction, breaks down, and then we get a big move to the upside, but tops out, can't reverse the trend at this point. Then the bears come back in, have another go at the trend, and can't take it through the old low. The market starts to break higher. Those that are selling it, looking for that push to new lows, they start to cover their losing short positions. Before you know it, look at this aggressive demand here. And then we close above the baseline, and that gives you your minimum projection, which comes in, I guess, around there for the price target for the reversal in trend. Now, don't forget, these projections are minimum price objectives. So if you're buying it here, you're looking for this area at minimum, but obviously you might want to take some profits there and maybe run the rest for a bit more. But there is no maximum projection. We're talking about a minimum projection based on these patterns. Another example, this is Kiwi dollar on a weekly chart. The market tops out here, starts to trend lower, lower highs, lower lows, lower highs, lower lows, aggressive break lower, market bounces, sellers come in, chop, chop, makes a new low, a marginal new low, can't really close below the previous swing low. Then it starts to go a little bit higher. So those, again, that are selling it on the approach or even on the break of this low are starting to worry as the market starts to break higher. These are psychological patterns which reflect mass psychology. So as the market starts to nibble higher here, eventually we get up towards this baseline, and then the market, in this case, initially tops out close to it, as markets tend to, as they get close to resistance and support levels. A lot of people take profits, the short-term guys and ladies. Market breaks through, corrects back, but eventually settles above this baseline. So you've got yourself, again, a minimum projection based on the baseline minus the lowest point projected up from the breakout point, which is here. And that comes in pretty close to where the market topped out. Another one, this is the dollar against the Chinese yuan, a 15-minute chart. So just to sort of go on for something here for intraday traders. So the market is trending higher, higher highs, higher lows, higher highs, higher lows. This pullback here finds support a little bit above the old swing high, which is quite normal, quite healthy within an uptrend, as did this pullback here, find support around the old resistance level here. So healthy bullish action. And then the market starts to trend higher a little bit. And now everybody's thinking we're going to break higher, make a new high as we did previously. But in this case, there was not sufficient momentum to take it through the high. Then the market tops out, starts to head lower, aggressively so at this point, as people that are buying it here start to bail out. And then we break through the neckline, or the baseline, sorry, and that confirms the double top pattern. And again, we have the minimum projection based on the high of the pattern minus the baseline projected from the baseline down. Okay, so that's a couple of reversal patterns. These are patterns which kind of confirm a reversal in the trend. Now I'm going to talk a little bit about continuation patterns, which are obviously a lot more common because trends tend to persist rather than reverse. So a continuation pattern is a period of sideways to counter trend slightly action as profit taking occurs after a swing in the direction of the trend. Once the pattern has been complete, usually confirmed on the closing break of the trend line, then the trend usually resumes and we get an extension of the trend. And it's a good idea to be buying if it's an uptrend after completion of a bearish continuation pattern to the downside. So if you're a swing trader, now let's break this down into trend traders and swing traders. A trend trader will buy on a bullish reversal pattern and hold all the way through until the reversal, until you get a bearish reversal pattern. But if you're a swing trader, you're looking to enter a trade after a corrective pullback. So that's what these continuation patterns are there to help you with if you're a swing trader. So you identify the trend or the which way momentum is going by a sharp move up or down, and then you look for a pullback against the trend. And once that pullback has been completed by confirmation of the completion of a continuation pattern, then you have an entry point to have a go in the direction of the trend. So a swing trader will wait for completion of the pattern, a continuation pattern, before joining a trend. The price targets, as with the reversal patterns, we have the width of the pattern from the break point, but also in the direction of the trend we have what is known as a measured move. So what technicians will be doing will be looking at the measuring the size of the swing that occurs before the correction, and then adding that to the break point, the point at which the market completes the continuation pattern. So you've got a couple of objectives to shoot for if you're trading in the direction of a trend after a pullback. Okay, measured moves. How do they work? So a bullish setup is where the market swings higher, often within an uptrend, or maybe it's the first impulsive move after a bear market. So the market swings from point A to point B, and then we get the consolidation, sideways to lower price action as profit taking occurs. And then when we get the closing break of the downtrend line here, that gives you completion of the pattern. And then what we're doing is we're measuring swing A to B from the last higher low, or the end of the pattern. So in this case, point X. So A to B distance measured, added on top of point X to give you Y, which is the measured move target. On the way down, market swings lower, market corrects higher, and then the market breaks through the support line here at this point, and then we know the pattern's complete. Then we know that the market should be headed lower. Where's it going to go? We're looking at swing A to swing A to AB, so distance A minus B subtracted from point X, which is the end of the corrective move. So that gives you the target for Y. Okay, so that's measured moves. Now I'm going to talk about triangle patterns. Now there are a lot of they occur quite often in these markets, particularly on daily charts. And I'll show you some examples a bit later again. Triangle patterns most of the time are continuation patterns usually, but also they can be reversal patterns, and you'll know that once they've been completed by a closing break. So as with all consolidation patterns, they occur after a swing in the direction of the trend as people start to take profits after that swing. So there are three types of triangles in classic technical analysis: an ascending triangle, a descending triangle, and a symmetrical triangle. So the price action is obviously contained by the converging trend lines within the triangle pattern. And obviously, once you get a break outside of the trend line, that tells you that the pattern has been completed, and we can start to come up with objectives and trading strategies in the direction of the breakout. One thing worth mentioning for those that use technical analysis for stocks and maybe futures as well is that the traditional theory holds that when markets go into consolidation, volatility and volumes start to decline because there are not so as the market is not moving aggressively, the expectation is of where the price should be in the future comes down, so everything contracts. So triangles can be good locations to maybe go for an option buying strategy like a straddle, buying calls and puts, because volatility comes down, and eventually once the pattern breaks, then you'll get typically an explosion in volatility, most likely in the direction of the breakout. So again, the close outside the boundary of the pattern indicates completion of the pattern and gives you the directional bias, and you can start to come up with your price projections based on the width of the triangle, and also there will be measured moves, measured move targets as well based on the trend if it's in the direction of the trend. So not only should, as I mentioned, triangles can also be reversal patterns. It's a fair assumption that the triangles will typically be continuation patterns, but obviously you have to be on the alert for completion of a reversal triangle pattern, and I'll show you some of these as well. Okay, so just a graphical representation of the main types of triangle. This is the ascending triangle, in other words, the bullish triangle, where the market is swinging higher within an uptrend, comes back down, forms a higher low, rallies again, fails at the old high, the way that a double top would do. Market pulls back and then forms a higher low above the last reaction low, often significantly higher. So we get a nice slope to the upside for this triangle. So then the market chops around and eventually breaks through this horizontal line at the top. So eventually those that were selling at this point, the supply runs out and then the market just finds a new equilibrium point at a higher level. Okay, so that's the ascending triangle. And again, the close above the upper line completes the pattern, and then we start to put in our objectives. Descending triangle, this is the bearish triangle. The market is trending down, forms a temporary base, bounces up. Sellers come back in as they would normally in a bear market. Market breaks down, finds again support close to the same level, bounces up, but this bounce is very weak, fails to take out the last lower high, and eventually the market falls under its own weight. Demand runs out, and then the market starts to collapse because we've run out of buyers at this price level. So the market has to find a new equilibrium point lower down. Symmetrical triangle, this is the interesting one, which can also be a reversal pattern. So what happens here is the market, in an uptrend, you've got the market swinging higher, then you get this kind of like wild oscillations, but the trend lines here are converging. In other words, we are seeing a higher demand line connecting these higher lows within the pattern, but also we're seeing a falling supply line which is connecting these lows, these highs, sorry, as one would normally see in the descending triangle. So what we've got here is the market in a point in a kind of a point of equilibrium. The bulls and bears are kind of fighting it out. Nobody knows which way it's going to go, but eventually, more often than not, the market will continue in the direction of the previous move. So the market closes above the top of the pattern. And again, you've got your projections based on the widest point of the pattern projected from the breakout. And also you have measured move targets in the direction of the trend. But again, watch out for this reversal one, because sometimes it could just top out and eventually the market can start to break down. And that will be the bearish reversal symmetrical triangle pattern, which again, I will show you some examples of later. Okay, so a few examples of the triangle pattern. This is dollar China, Chinese yuan. The market at this point is in a downtrend, making lower highs and lower lows. Market bounces back up, fails below the old support level, as one would expect, starts to go into this two-way consolidation period. So we've got a kind of a point of equilibrium in the middle of the pattern. Bulls and bears are fighting it out, and it doesn't really want to go anywhere fast. But more, as I say, more often than not, these patterns typically resolve in the direction of the previous swing or the trend. In this case, that's what happened. The market eventually broke through the rising support line. Don't forget, in a symmetrical triangle, the support line is rising and the demand line is falling. So we broke through the rising demand line, and that confirmed completion of the pattern, and then the trend started to resume. So again, we have the minimum objective based on the widest point of the triangle, which is here, projected from the break point, which is here. And also we have swing objectives based on the last swing down, projected from the break point here, or from the last reaction high here. Okay, this is a descending triangle, dollar yen, weekly chart. So the market is trending higher, reverses, sort of a double top here, breaks down, finds support around the last or one of the important reaction lows. Market starts to attract demand, but then tops out, starts to break lower, and then we get this support coming in on the approach to or just below the last important swing low. So this line here becomes a support line, but what we're seeing is the market fail on the upside attempts. We've got the line connecting these two lower highs, and eventually the support line gives way, and then the market accelerates to the downside. Okay, again, dollar yen. This is a daily chart of dollar yen. And just to show you three examples of the symmetrical triangle, two continuation and one reversal. So what we have is an uptrend. The market goes into consolidation mode. We get the break of the falling demand supply line here, completes the pattern. Market aggressively moves higher, tops out, comes back down, goes into consolidation again, closes above the falling supply line, goes aggressively higher, tops out, comes back down, tries to go up and make a new high, but again fails. So potential double top at this point, breaks down, then makes a higher low, then breaks up, makes a lower high, comes back down, and eventually we just break to the downside. So this one, we would normally expect it to be a bullish continuation as per the previous two, but instead we get the closing break of the trend line here, which confirms it as a reversal symmetrical triangle. And then we can see what happened next here, an aggressive move to the downside. Okay, so now on the in the theme of continuation patterns, I will talk now about so-called flags and pennant patterns. So flags and pennants are, I'd say, a lot more common than the triangles and the double tops and the head and shoulders, the larger patterns. They tend to be shorter in time and narrower in width than triangles and the other patterns. So they tend to be a lot more common. They might, whereas a triangle might take maybe a month or two to unfold, a flag or a pennant might take a week or 2 weeks to unfold, just as an example. So they reflect a brief pause in the trend before a quick resumption of that trend. So flags slope against the trend, whereas pennants, they're a bit like triangles where you've got two trend lines. You've got a rising support line and a falling demand line, supply line, as with the triangle, but as I say, with much shorter duration. So they're like mini symmetrical triangles. And again, as I mentioned with volume, if you're into volume, if you use volume in your analysis, the volume, you're looking for a decline in volume as the pattern unfolds. And as the market breaks out, you should see a sharp movement in price and a big increase in volume if you're looking at something like stocks or maybe futures. And once they're complete, you have your measured move targets. Okay, so this is what they look like. A bullish flag, so the market is trending higher. You get a nice demand swing here. Then the market starts to do the chop thing, but the action is very, very tight, very, very shallow. So a little bit of a sort of counter trend action, but not aggressively so. It breaks down, but when it breaks down, it doesn't want to go down too far too fast, comes back in. So this is people taking profits, but also new buyers coming in, new trend buyers or swing traders coming in, looking for that next swing higher. So eventually with these patterns, once the temporary supply has exhausted, people have taken their profits, short sellers have gone in and they've committed themselves. The market closes above the falling supply line, and then you have your completion of the flag, and then you're looking for your measured move target. Pennant, similar kind of thing, except that the demand and supply lines are converging as per the triangle, the symmetrical triangle. So you get the swing higher for a bullish situation. The market goes into chop mode. We get slightly higher highs, slightly lower highs, slightly higher lows, and eventually the closing break of the supply line, and that confirms completion of the pennant, and away we go with the trend. Enter in the direction of the trend, place a stop loss, and look for the measured move. Okay, more, I'd say a bit less common, and a bit like the triangle and the double top, that kind of thing, are wedges. Now, wedge patterns are kind of long corrections against the trend. So a little bit like a flag, they will slope against the trend. In fact, they look like a new trend in the other direction, in the opposite direction. And in fact, they are, but a very, very shallow one. which reflects kind of a slight change in psychology. But once a wedge has been completed, you'll get a big acceleration higher in the direction of the previous move. So the pattern is contained by converging trend lines. In other words, they're not parallel. The trend lines are kind of like moving towards each other, but they are sloping against the previous trend. So again, you're looking for volume to dry up within a wedge pattern as the daily ranges contract, and a close outside the trend line will signal completion of the wedge. And now we're looking for a big move in the direction of the trend, and we're expecting higher volumes and expanded daily ranges on the breakout, and you're looking for measured move targets again. A rectangle. Now these are lateral sideways trading ranges that you see after a trend move. These are quite common, where the market just tops out after a trend swing into the upside and goes into a kind of a chop mode between two boundaries, a high and a low, and that contains price action until you get a resumption of the trend. So we have horizontal trend lines, a bit like a double top, but it turns out not to be a double top. You see the market break in the direction of the trend. It's a continuation pattern. So while they're forming, they can appear to be like a double or a triple top, but obviously what happens is the market eventually resolves in the direction of the trend. So as with the other patterns, you're looking for a close outside of the rectangle to signal completion of the pattern, and look for high volume and expanded ranges once you break in the direction of the trend after completion of the rectangle. Okay, so just to show you what they look like, these are bullish examples of the wedge and the rectangle. So the wedge pattern, so that the market swings to the upside, then you get this kind of, it looks like a start of a new downtrend. So the market is making lower highs and lower lows, but notice how the supply and demand lines are converging. So in other words, as the market is going, making lower highs and lower lows, admittedly, but there's no thrust, there is no aggressive selling, which takes the market to much lower levels. So what's happening is you've got people taking profits on the long side, but also you've got early buyers coming in looking for that new, the next leg of the trend. So again, once the wedge has been completed, confirmed on the closing break of the supply line, then we can start to do our measured move targets to the upside. A rectangle, similar kind of thing. The market swings to the upside, goes into this kind of trading range. So up, down, with the highs pretty much at the same kind of level, the lows pretty much at the same kind of level, but eventually we get the closing break in the direction of the previous swing or the trend. And that says that we've completed the pattern, and now we're looking for the measured move target. In this case, the width of the rectangle measured up from the break point here. Okay, worth mentioning the very rare, but it does occur sometimes, continuation head and shoulders pattern. So this one occurs during an uptrend. This is a bullish example. So the market is making higher highs and higher lows like this. Market pulls back, retests the high, but fails as in a double top. Then it breaks down through the support. So you've got yourself kind of a double top situation here where you're looking for the market to break down, which it does. But in this case, when the market rallies back up again, it rallies all the way through the support level, the old support level, but tops out close to the old swing highs. And then the market pulls back, bases out around the left shoulder as per the reversal pattern that we looked at earlier. And then eventually demand comes in, the market breaks up through the neckline, and that completes the pattern. So psychologically, what we have is a situation here where the market, on the break of this left shoulder here, everyone goes short, then the market bounces back. We're expecting new supply to come in here within a downtrend, but it doesn't. So the market breaks up here. All of the sellers here are now trapped. So they'll be looking to get out on the approach to this neckline should the market come back. Market does come back, people start to cover their losing short positions here, and that drives the market higher. Then eventually you get the proper breakout, the real breakout in the direction of the trend, and everybody jumps in, and then the market goes to the next higher level. So as with all of these patterns, we have projections, minimum price objectives based upon the widest point of the pattern projected up from the break point. Okay, so that pretty much covers the presentation on some of these patterns. There are other ones that that people look at, but for today's session, I think that's quite a lot to be getting on with, just some of the basic ones. What I want to do now is just switch across to MetaTrader, just to show you some real life examples of these patterns, and to show you some of the patterns which are kind of in play right now. And to give you my my take based upon this price pattern analysis. So let me just switch across to the CFI MetaTrader. Okay. Okay, so this is the CFI MetaTrader. I'm just going to run through some of the markets and some of the patterns that I've seen in the past, and some which are currently in play. So first thing I'll do is I'll go across to euro dollar right here. So what we've got in euro dollar here is, just want to show you a couple of these symmetrical triangle patterns that that we've had. So this one here, between March and May, we had the market do a very large symmetrical pattern, reversal pattern. So the market obviously was previously in a downtrend, and then we got the bullish confirmation on the close up here, and then the market turned to the upside. So this triangle pattern basically reflected a gradual shift from bear to bull, then the market started to trend higher. After this initial thrust out of the pattern, the market started to correct into a what could be a pennant or a symmetrical triangle pattern, depending on your viewpoint, but either way had the same implications. Once we broke through the supply line on a closing basis, that told us that the consolidation was complete and that euro dollar should go high, which it did. Now, recently, this is where we are. This is the last month or two. So the market is it's struggling on the approach to 120, the psychological 120 number. And what we've got here is the market, it looks like it could be a head and shoulder top pattern. So what we've got is the market breaking up here to the swing high, pulling back, then breaking through the last swing high, topping out, reversing just above 120, all the way back down to the neckline. Support comes in, breaks up, can't get up towards the left shoulder of the pattern, or there, depending on how you draw it. It could be drawn as a slightly sloping one. Then the market breaks down here. This is today, by the way. So we've broken down, we've broken marginally through this neckline of the pattern, but we are attracting demand just below the head and shoulder, potential head and shoulder neckline. Now, don't forget what I said about the pattern is not complete until you get a closing break outside of the pattern boundaries. So sometimes what you'll get is a fake out, where the market breaks through the trend line, the demand or supply line, and then snaps back. So those that are trading on an intraday basis, they sell it thinking this market is going to make a head and shoulder top today. But guess what? It doesn't. The market bounces back up, and by the close, the market is back above the neckline. So that's why it's good to wait for the closing break of a pattern. So what happens if the market fails to break down through a support level like this? Then it's quite possible that you will get a very big powerful move in the opposite direction. You can imagine today's sellers selling the breakout, looking at this head and shoulder top, thinking we're going down to 115, which is roughly where the projection is based off of this top. But lo and behold, anyone who's sold it today is finding themselves underwater. So let's watch this space. Could be a good stab on the long side based on the fact that this market is still in an uptrend. Okay, that's euro dollar. Now, conversely, euro yen, which often follows euro dollar, has actually completed a bearish head and shoulder top yesterday, and we started to get the move lower. So the yen is acting a little bit differently to some of the other markets. So the yen has kind of led the market down a little bit. So we got the closing break of the neckline. You can see the break. This is a nice healthy uptrend. Market pulls back, demand comes in, breaks up to a new high, fails to sustain it, breaks down, finds support at the last reaction low, breaks up, struggles to let these guys off the hook, the ones who bought the break of this last high, tops out, breaks down, and we've got ourselves a head and shoulders top pattern. And the projection on this one, by the way, comes down at I think 121.80, which is down here. So we'll have to watch this space. It'd be interesting to find if euro dollar does start to rally aggressively, whether dollar yen absolutely collapses and this continues lower with dollar yen. So it'd be interesting to see how this pans out. What else I wanted to show you? Gold. Gold has been forming a symmetrical triangle since forming this big swing high, going back to last month. So the market formed the swing high within the uptrend, and then we've got this kind of two-way action here where we're seeing higher lows and lower highs. And again, draw the trend line connecting the swing lows and the swing highs. We had a marginal break to the upside yesterday on this triangle. It briefly broke through the supply line, but reversed on the FOMC yesterday, and we've seen a little bit of a probe lower today. But again, we're still within the confines of this consolidation. My best guess is that we're going to eventually break to the upside because these patterns typically are they are consolidation patterns, and then we make new highs for the trend. But obviously, you need to be on alert for a closing break of the demand line. If that happens, then we have a reversal pattern, and we have to go short. We have to go with the new facts on the ground, shall we say? Okay, one last example. I think I wanted to show the FTSE. The FTSE is doing a falling, looks like a falling wedge type pattern, where the market obviously formed a bear market low or a correction low, depending on how you look at it, bounced back up, and then topped out. And now we're starting to see this lower high, lower low situation, but there's no aggressive selling. In other words, in a downtrend, this is a real downtrend. The market makes lower highs and lower lows, and when it breaks support, it breaks it aggressively. Here, we break support, but we're not breaking support aggressively, we're bouncing back up. So there's some latent buying pressure that's coming in on the FTSE at this precise time. So watch out for the closing break of this falling wedge resistance line. Once we get that, if we get that, it may just top out and break lower, but should we get that, then that for me would be a very good bullish indication for the FTSE 100 index. I think I wanted to have one last look at dollar yen. So dollar yen has been, it seems to like doing these triangles, dollar yen. Dollar yen has been, after moving sideways for quite some time, broke down. It's been making lower highs and lower lows. Recently, we broke through the bottom of a symmetrical triangle, and we've seen this move to the downside. So this one looks like it's leading the way down. The price projection based upon this pattern comes in around 102, which is not a million miles away from this last panic low. So whether it occurs in line with the stock market going down, that will depend to a large degree on whether the this is the S&P 500, whether the S&P 500 can break and settle below this last swing low. I would say not too much in the way of classic patterns at the moment. You might want to put a couple of trend lines on this and call it a pennant, but it's not that clear for me. But I think if we can break and close below this this low of the last week or so, 2 weeks, then that would give a bearish indication. But right now, the uptrend is still pretty much intact. So keeping an eye on the S&P 500 for a closing break below the recent swing low. That might be the key to whether dollar yen starts to accelerate down to 102. Okay, so that pretty much wraps up the webinar. If anyone has any questions, please feel free to fire those across. I'll wait for a few seconds if anyone seems to wants to fire a question across. I've been doing a lot of talking, so I'll have a quick slurp of coffee. Thank you, Khalil. Thank you, Khalil. And by the way, if anyone's got any questions on the content, someone's typing. If anyone's got any questions on the content of this this presentation or any of the presentations that I do for CFI, please feel free to contact your CFI rep or contact, and I'll be happy to address any questions through them. So be nice to think that you guys are getting something from these presentations. Just waiting for thank you, Jordan. Thank you very much. Okay, so I'll bid you all farewell. This time 5 o'clock UK Swiss time, 4 o'clock UK time next week. I'll be doing another webinar, so I hope to see everybody there. Thanks very much for coming.